As we look at the boards right now, the market is closed for the weekend, and Micron Technology ended the last live session on Friday, July 17, 2026, at an exact closing price of $853.20 per share. This final number represents a significant intraday slide of 5.65%, putting a cap on a highly volatile week that has seen intense pressure rippling across the entire semiconductor landscape. The immediate instinct for most retail traders looking at this steep drop is to assume that the semiconductor tailwinds are fading, or that the massive run the stock enjoyed over the last 12 months is officially giving way to a structural bear market. But here is the perspective shift that the broader market is failing to see in real time. This aggressive sell-off is not being driven by a sudden collapse in corporate profits or a drop in enterprise order books, but rather by an unprecedented supply chain bottleneck and massive capital expenditure adjustments from major global foundries. While everyday headlines point toward macro anxieties, institutional desks are quietly capitalizing on this price distortion, recognizing that the global deficit in high-bandwidth memory chips is actually widening, not shrinking. The general consensus across mainstream media and common investing sites is that the chip boom has peaked. The logic seems straightforward enough. When a stock goes from a 52-week low of just over $100 to a peak near $1,255, a massive pullback is not only expected, it is healthy. Retail market narratives suggest that high valuations leave no room for error, and any sign of broader tech weakness means it's time to cycle out of hardware and move back into safer defensive plays. This conventional narrative, however, fundamentally misunderstands the structural shift happening within data center architectures. When you look deeper into the actual hardware requirements for training large language models and running complex agentic intelligence networks, the storage and memory capacity are the true constraints, not just the raw processing power. The reality is that the market is punishing a sector for spending money to expand its capacity, while completely ignoring the fact that the underlying demand is locked in with multi-year cash deposits and advanced customer purchase commitments that stretch well out into the coming years. If we examine the recent daily trading volume and the technical patterns forming around this current price level, we see a fascinating battleground. The trading volume during this recent downward push spiked significantly above the 3-month daily average, which usually indicates institutional rebalancing rather than simple panic selling by individual brokerage account holders. A huge portion of this momentum down was accelerated by exogenous sector shocks, particularly the recent second quarter reports from large global foundries that indicated capital expenditure forecasts are rising sharply. In the upside-down logic of the current macro climate, when a semiconductor titan announces it is spending tens of billions more on manufacturing infrastructure, the market immediately panics about oversupply risks down the road, initiating a sector-wide correction that drags down highly efficient operators like Micron, Nvidia stock, and Apple stock. This macro pressure has created a classic disconnect between near-term price action and the actual cash flow metrics being printed quarter after quarter. Institutional positioning reveals a very clear dichotomy between what the short-term aggregate derivatives market is doing and what long-term wealth management desks are executing. For instance, high-profile short positions from notable macro funds have placed a bright spotlight on the stock, betting heavily on the cyclical historical patterns that have historically defined the memory industry. This has emboldened short-duration traders on popular platforms like the Robinhood app to short the name or hedge using downside options contracts. Meanwhile, the underlying filings show that large institutional exchange-traded funds and massive mutual funds still retain an exceptionally high percentage of the total outstanding float. These large-scale asset managers are not treating this correction as a terminal event. They are looking at the fundamental pricing power that the company holds over cloud providers, who simply cannot deploy their next-generation computing clusters without these specific high-bandwidth architectures. Let us pause for a quick moment to check in with everyone watching this analysis unfold. Comment below how many shares of Micron Technology you currently hold in your personal portfolio, or let me know if you are using this recent dip to accumulate more positions through your own self-investing strategy. To fully comprehend why this tension between market expectation and reality exists, we have to look closely at the underlying business model. The company operates as one of the few global titans capable of producing dynamic random access memory, commonly known as DRAM, alongside NAND flash storage solutions. Historically, this was a deeply cyclical, commoditized business heavily tied to the ups and downs of personal computer shipments and smartphone upgrade cycles. When consumer electronics demand surged, memory prices skyrocketed, leading to massive capital investments. When demand cooled, the market faced an oversupply, margins crashed, and earnings cratered. This historical boom and bust cycle is exactly what worries traditional analysts who view the company through an older lens. But the modern business model has shifted from selling low-margin components for consumer electronics to delivering highly specialized proprietary memory systems designed for hyperscale data centers, enterprise solid-state drives, and intelligent automotive computing ecosystems. Looking back at the structural history of the financials, the transformation becomes glaringly obvious. The legacy reports from prior fiscal years showed a corporate profile plagued by massive swings in gross margins and deep net income drawdowns during global tech lulls. However, the recent fiscal third quarter results completely broke those old boundaries, showing total revenue climbing to a staggering $41.46 billion, a massive leap compared to the prior periods, with non-GAAP earnings per share landing at an impressive $25.11 per share. Gross margins surged past the 84% mark, demonstrating a level of operating leverage that simply didn't exist in the older eras of the semiconductor business. This extreme profitability is driven by the structural shortage of high-bandwidth memory products like HBM3E and the upcoming HBM4 platforms, which are already completely booked out by primary enterprise clients through the entirety of next year and well into the following year. The company has even secured billions in strategic agreements backed by massive upfront cash deposits from major cloud customers who are desperate to guarantee their future hardware supply. When evaluating where to allocate capital across different investing sites, today's investor has access to an immense array of tools, ranging from managed options like Schwab Intelligent Portfolios or a specialized SoFi robo-advisor to self-directed alternatives such as an individual brokerage account or an advanced interactive brokers platform. No matter which channel you prefer for online investing, the critical skill is identifying when the structural reality of an asset diverges sharply from the prevailing headline fear. Right now, the market is pricing in a severe downside scenario where global memory capacity expands too quickly, creating a glut that erodes pricing power. Yet when you look at the capital expenditure guidance, which is projected to rise into the mid-$40 billion range as new manufacturing infrastructure gets built out in domestic hubs, it becomes clear that this spending is meticulously aligned with multi-year customer demand rather than speculative overproduction. As we pivot our attention toward the future outlook, several distinct operational scenarios begin to emerge. In the most optimistic scenario, the ongoing build-out of major data centers continues unabated, and the integration of advanced localized intelligence platforms into consumer smartphones and personal computers triggers a massive structural replacement cycle that keeps memory pricing exceptionally strong. Under this framework, the recent dip to the mid-800s becomes a transient blip on a longer chart that analysts from major research institutions believe could eventually target levels well north of $1,500 per share. The company's expanding push into strategic automotive supply agreements for intelligent vehicle systems provides a highly resilient, non-cyclical revenue stream that could further protect the balance sheet against traditional consumer tech slowdowns. Conversely, we must carefully weigh the realistic headwinds and structural risks that could validate the contrarian perspective. The primary threat stems from aggressive domestic infrastructure spending by major international competitors who are rapidly building out alternative production facilities. If global production outpaces the actual implementation speed of enterprise software systems, memory prices could see an unexpected softening in the latter half of the decade. Furthermore, any broader geopolitical disruption affecting the complex semiconductor supply chain or international shipping lanes could immediately restrict access to critical raw manufacturing materials, driving up production costs and pinching those record-breaking gross margins. Investors using active trading strategies on platforms like the Fidelity trading platform or tracking macro flows